value of share appreciation right was 10, and it was estimated that 5% of the employees could leave during the vesting period. And then you show the fair value of share appreciation rights at various dates were as follows. So at the end of 2020, it was the fair value of share appreciation rate was 9, 2021 it was 11, 2022 it was 12. And then you're told all the employees who are expected to leave, all the employees who were expected to leave did leave the company as expected before 31st of March 2021. And then you're told on 31st of March 2022, 60 employees exercised their option when the intrinsic value of the intrinsic value was shillings 10.5 and were paid in cash, were paid in what? In cash. And then you told the chief accountant of M Limited is, however, confused as to whether to account for the share appreciation rights under IFRS 2, share-based payment, or IFRS 13 fair value measurement, and would like to be advised on how the share appreciation rights should be accounted for from the grant date up to 31st of March 2022. So in this case, we require to advise the chief accountant of M Limited on how the above transaction should be accounted for in its financial statement with reference to the relevant international financial reporting standard. So basically, what's the question of the testing here? Number one is on how to account for this particular transaction based on the relevant standard, and number two, equally there was you needed to give some small explanation or actually to advise this accountant, will he apply IFRS 13 fair value measurement or basically IFRS 2, the share based. Automatically, the standard to be applicable here is IFRS 2. And even before I explain the difference between these two standards, IFRS 2, IFRS 13, now, anytime you come across the share appreciation rate, this one is basically equivalent to what we refer to as the cash settled employees shareholder option. So basically, this is a promise by the company to pay a cash or basically a bonus to the employees in the future, which will be equivalent to the market price of the market, or which will be equivalent to the market price or the fair value of the company shares in the future. So the employees here will be paid a bonus, will be paid a cash in the future, and that bonus or that cash will have to be computed based on the market price, based on the fair value of the company shares on the exercise date. Date. So therefore, these are share appreciation rate. Not much difference with what we did, but this is equivalent to what? To the cash settled employee share option. But before we go to the question itself, what is the difference between these two standards? IFRS 2 and basically IFRS what? IFRS 13. IFRS what? 13. Now, the first standard here, that is IFRS 2. Basically, we know that this applies, or this should be applied whenever a company is accounting for what we refer as a share-based payment transaction. So we can basically say that IFRS 2 is applicable when accounting for a share-based payment transaction, a share-based payment transaction, a share-based payment transaction, share-based payment transaction such as employees share option. Employees share option. Remember, you said employee share option. This whereby the employees have been promised by the company to be paid a cash or a bonus in the future, which will be equivalent to the market price or the fair value of the company shares in in the future. So alternatively, we say that the company here may give the employees a privilege or basically right to buy the shares of the company in the future at a price below the market price. That is an employee share option. It is a good example of a share-based payment transaction. And actually, that one falls within the scope of IFRS 2. It should be accounted for in accordance with what? In accordance with IFRS 2. So what about IFRS 13? So this basically deals with the fair value measurement. Fair value measurement. Now, this particular standard here basically is applicable whereby the company wants to measure something called the fair value less cost to sell of an asset. I hope you can be able to recall, for example, in the topic of impairment of assets, we talked about something called the recoverable amount of an asset. And actually, see, the recoverable amount of an asset is usually the higher of two values. The higher of value in use, and number two, the fair value less cost to sell. Now, we say the fair value less cost to sell is the estimated selling price of an asset less the cost which will be incurred in selling that asset. So this particular standard here should be applied by the company when determining the fair value less cost to sell of what? Of an asset. Of what? Of an asset. So therefore, you can say IFRS 13. This is applied in measuring the fair value less cost to sell, less cost to. There are some notes I was to share with you, or I shared the same. Did I share that in the class WhatsApp group? Yes or no? The theory topics. And I think I'd promised to share those theory. Okay, so make sure you remind me to share the same diagrams immediately after class. Yes. So in question 4b, we are told Munro Limited, a manufacturing company, provide for deferred income tax in accordance with IAS 12 income taxes. The following is an extract from the statement of financial position as at 30th April 2017. We are given various items of non-current assets, current assets. We have equity, non-current liabilities, and current liabilities. And then we have additional information, number 1, 2, all the way to note number 9. What are we required to do here? We are required to compute the deferred tax balance as at 30th of April 2017. And also we are required to prepare the deferred income tax account. Now, we're going to start with the Roman 1 of that particular question. And basically what we are required to compute is the deferred tax balance. The deferred tax balance basically at the end of the year, that is on that year of April 2017, that year of April 2017. Now, remember what we said here is that this deferred tax balance at the end of the year can either be a deferred tax asset or can be a deferred tax what? Liability. Someone is saying my board is not clear. Maybe you can confirm. Yes, so for us to be able to compute these deferred tax balance at the end of the year, automatically we are required to compute the deferred tax asset or the deferred tax what? Liability. Now, for us to compute that deferred tax asset or deferred tax liability at the end of the year, we need to compute something called the net temporary difference. We need to determine whether at the end of the year we have a net taxable temporary difference or a net deductible temporary difference. So how do we do that? We basically have to pick or to take the items which are given basically from note 1 all the way to note number, I think 8 or note number 7. We compute, we determine their tax base, we determine their carrying amount, and then the difference will automatically be what? B, the temporary difference. B, the temporary what? A difference. Is the video okay? Video iko sawa? Naona is back to us. Is back to us. Or is still working? No, I can see that it's not working at all. It's not working at all. Yes, sawa. So maybe you can do this. Let me give you like 2 or 3 minutes. You just go through the question, and maybe from whatever you give and share in the additional information, those assets, you identify those assets and liabilities, you identify the carrying amount, and you determine the tax base. I restart the internet. I see whether there'll be some improvement. This is a question we are doing, Regina. This is a question we are doing here. Sasa? Yes. We start with the external reconstruction, and specifically we're going to start with that question here. We start with the question for August of 2022. August 2022. And this was question number what? This was question number 4. Question number 4. So if you are here, please confirm. If you have the question with you, just confirm. Just confirm whether you have the question. Yes, confirmed by Elizabeth. Confirmed by Patrice. Okay, so what are we told as far as this question here is concerned? What are we told here? So the question reads: Tagga Limited is a private company, private limited liability company operating in telecommunication industry. The company has suffered successive trading losses for a number of years, largely due to stiff competition. Yes, that's what I'm recording. Largely due to stiff competition and a sharp decline in the revenue. So we are told the directors of the company, who are also the main shareholders, agreed to restructure the company by transferring it to a new company to be named 𝐿EWA, Limited. So automatically, this is an external reconstruction because this company, which is called Tanga, we are told it will be restructured by transferring its business operation assets and liabilities to a new company, which is called 𝐻𝐿 Limited. So then you're told the statement of financial position of Tanga Limited as at 30th of June 2022 was set out below. So we're given the statement of financial position of that company before the reconstruction. We have the non-current asset, current asset, we have equity, non-current liabilities, and current liabilities. Then we have additional information number 1 or the note number 9. And basically, if we go through this particular note here, whatever you're given in note 1, note up to note 9, and basically you compare with the other question which we did, you'll be able to see the notes are almost the same. The notes are almost the same because I say these questions for external reconstruction, they are the same. So the examiner will just try to change very few items, but essentially the questions are the same. So what are we required to do here? Part A, we are required to prepare the following ledger account to close off the books of Tanga Limited. Roman 1, the realization account. Roman 2, ordinary shareholders salary members account. Roman 3, the preference shareholders salary members account. And then part B, we are required to make the journal entries in the books of account of 𝐻𝐿 Limited to record the acquisition of Tanga. If you can remember the other question which we did, the examiner was not requiring the student to make those journal entries. And then part C, we are required to prepare the opening statement of financial position of this company, of the new company, as at 1st July 2022. So remember what we say is that once you come across such a question for external reconstruction, basically I think I talked about a number of steps which you need to follow. Number 1, we said compute the purchase consideration. Compute the purchase consideration which the new company is supposed to pay the shareholders and the financials of the old company. Number 2, close off the books of account, books of what? Of accounts of the old or the selling company. Of the old or the selling what? Company. Now, after doing that, like this particular question here, you have now to proceed and you make the journal entries. The journal entries to do what? To open the books of account, to open the books of accounts of the new company. The new what? Company. And then finally, you prepare the statement of financial position equally for the new what? Company. Essentially, these are the steps you should follow. But we said in an examination setup, I will not advise you to compute this because if you can remember the question we did yesterday, I think you can be able to recall how computation of the purchase consideration was demanding and also it is time consuming. So therefore, if you happen to come across this question in an examination setup, avoid computing this. Even without having computed that, you'll be able to get good marks, basically over 15 marks, without having computed that purchase consideration. So what we need to do basically, we will go straight to crossing of the books of account of the selling company, basically by preparing the relevant ledger account. So those are the ledger accounts we require to prepare in Roman 1, the realization, ordinary shareholders salary members account, the preference shareholders salary members account, to cross off the books of account of the old or the selling company. Then from there, we're going to make the journal entries for the journal entries to open the books of account of the new company. And finally, we prepare the statement of financial position of the new company. We'll be able to see that by using that particular approach, that question you should be able to do it within 30 minutes. You have more than 15 marks. You move to the other question. So therefore, you move to this one to cross off the books of account of the old company. But before you do that, it is important for you to recall what you're told in paragraph 1. The company which is to be structured is Tanga. This is a company which has been making losses, and this is the company which is to be liquidated. Its business operation, assets, and liabilities taken over by a new company, which you're told will be known as 𝐻𝐿 Limited. 𝐻𝐿 Limited. So therefore, this is the selling. In other terms, this is the old company, whereas this is the new. In other terms, we refer to this as what? As the purchasing company. As the purchasing what? Company. So the first thing we need to do basically is to cross off the books of account of Tanga. And we do that by preparing the ledger account we are required to prepare as per Roman 1 of that word question. So we move to, or basically we go straight to Roman 1 of the question. And we are required to prepare the relevant ledger account to cross off the books of account of Tanga. So part A of the question, ledger account to do what? To cross off books of accounts of who? Of Tanga Limited. So which ledger account do we prepare? The ones which are listed there. The realization account, we're going to start with the realization account. The realization account. Then from there, we will prepare the other ledger account, which is called the ordinary shareholders and members account. Ordinary shareholders